Welcome to our conversation on financial reporting and the markets. In this session, we will focus our attention on offer for sale, popularly known as OFS. Is this a route for profitable exit for the promoters and investors? Of late, OFS was in news. Several people occupying important positions have given their views on OFS. The Chief Economic Advisor, Mr. AnanthaNageswaran, has said during a financing summit, CII's Financing Summit in November 2025, that India's equity markets have grown impressively. But IPOs have increasingly become exit vehicles for early investors rather than mechanisms for raising long-term capital. And he stresses that this undermines the spirit of public market. He was questioning about raising doubts on IPOs with a significant portion going as OFS. Whereas the SEBI's chairman, Mr. Pandey, said in an IPO, there is an exit and money is also raised. In our view, a lot of companies are made with investors' money, and when they reach a certain scale and come up with IPOs, then some people exit. So these are two views, two different views. I will say two extreme views. One is questioning the OFS as a means to raise money from the investors by the promoters and early investors. The other one saying that IPO should have a balance, should definitely have a portion as OFS and also raising money. And if you see the numbers, we can see that last 10 years, 66% of IPO was in the form of OFS, 34 was only fresh issue. So the concerns raised by the chief economic advisor seems to be valid, that a large percentage of IPO was going to the existing promoters and existing and early investors. And if you see the data over a period of time, 52 to 80%, 87% of total OFS was in total IPO was in the form of OFS. So the funds raised via IPO for OFS has been high. So what is this OFS? OFS can happen, as the name itself shows, offer for sale. So the existing shareholders offer their shares for sale. And this can happen for a listed company or can be used by a listed company or an unlisted company. The focus of our presentation is on OFS as a part of IPO. But OFS can also happen for a listed company, which is a stock exchange based OFS, where the sale of shares happen by the promoters to dilute the holdings or to divest or to meet the minimum public holdings. IPOs, OFS as a part of IPOs is generally done by the unlisted companies. An offer is by the existing shareholder. The promoters and PE funds and other early investors use this route to exit. So OFS, who sells the shares? The existing shareholders sell the share. Will the company get money? No. Will there be a dilution of equity? No. Will the book value per share change? Book value per share is the total equity divided by number of shares. Since OFS, exclusive OFS, no fresh issue, no change in equity, no change in the number, so the book value per share will not change. So OFS, the key takeaways are OFS, the existing shareholders sell the share. The company will not receive any money. There'll be no dilution on equity and no effect on the book value per share. There are certain theoretical underpinnings to the OFS too. OFS has been a subject of research in finance, and one of the popular studies is a signaling theory of Ross. In 1977, a paper, The Determination of Financial Structure, the signaling hypothesis, talked about OFS, a variation of it. The company's insiders selling shares communicate something to the market, and that is the signal. And that signal can be a positive signal or a negative signal. The positive, if the insiders sell only a small portion, it can indicate confidence in the future growth. So because those insider, that early investors and the promoters, continue to hold control, they retain the control. But it can also be negative signal if they sell a large portion. It may be interpreted as lack of confidence. The signaling theory can be used to explain OFS. Another classic theory is the agency theory. The agency theory says that the early investors, venture capital, founders, early investors, the public shareholders, all these people have different incentives, and offer for sale reduces this agency conflicts by allowing early investors to realize gains without diluting or changing the capital structure, without affecting the operations. Theoretically, it aligns incentives. Public shareholders buy at a fair market value, and insiders or early investors get an opportunity to liquidate their holding. And this is a famous Jensen and Mackling's paper, Agency Theory and Separation of Ownership and Control. Similarly, OFS and capital structure, OFS does not raise any capital, fresh capital. So it does not affect the company's balance sheet or leverage. Theoretically, it allows wealth transfer from buyers to sellers, from the buyers to the buyers from the sellers without altering the firm's investment policy. So OFS can also reduce the overhang of privately held shares, improving market liquidity. So some of the important finance theories can be used to understand this market phenomena called offer for sale. Similarly, it's not that any company can go for OFS arbitrarily. There are certain legal conditions attached to the OFS too. SEBI's issue of capital and disclosure requirement, popularly known as ICDR regulations for IPOs and FPOs that include OFS. These regulations regulate, control the OFS. SEBI's several circulars for listed companies selling shares to stock exchange also regulate OFS. Stock exchange operational guidelines, they help in implementing the SEBI's regulation. So OFS is not just an arbitrary company alone. Any percentage of the shares can be sold at any point. Recent update of SEBI has improved the information or reduced the information asymmetry with respect to OFS. The SEBI's recent update is that mandated clearer disclosure of names and holdings of selling shareholders. Now, if you open a prospectus today, you will invariably come up with the details of the companies or the individuals or the investors who are selling shares or offering shares for sale. Not only the number, but also the weighted average cost of acquisition. So we can easily find out what percentage of shares have been offered for sale and what amount of profit these people are making. So let us see some recent OFS. I've just picked up randomly few just to drive in and examine who are these companies, what type of companies are going for OFS, what is the nature of the OFS, what percentage of IPO is actually going for OFS. Hyundai Motor is a classic example. Hyundai conducted entirely OFS. The company's South Korean parent, Hyundai Motor Company, offered 142 million shares to the market via IPO. This is a 100% OFS part of IPO made by a foreign promoter to Indian market. And the IPO size was about 27,000 crore, one of the largest or the largest as on that date, 27,000 crore. And the company wanted to go to the market to list to improve their the visibility and brand image. So the weighted average cost of acquisition, as mentioned in the prospectus, is 10. The price is 1960. So the promoters or the parent company made a return on investment of 19,500%. And the cash outflow from India to Korea is about 27,000 crores. Pine Labs, out of an offer, the total IPO of 3,899 crore, 1,800 crore was in the form of offer for sale, which is one of the recent IPOs. And here also we can see that several investors, early investors, made high percentage of profits. Because the weighted average cost of acquisition are different and low. So the margins or the return on investment range from 175% to 45,000%. So this was an opportunity which these promoters or investors made use of to earn huge returns or hefty returns. Another popular company which use IPO route to go for OFS is the Lenskart. About 70% of IPO was OFS. Here also we can see that the promoter or the people who have divested and offered their shares made a return of in the range of 2,000 to 5,000%. The weighted average cost of acquisition was in the range of 8 to 18. The issue price was 400. JSW Cement, about 56% of the IPO was OFS. And here also we can see that the return on investment was more than 100%. We Work India, here 100% of IPO was OFS. And the return on investment for the investors who offered this shares for sale was 300 and 800% respectively, because of the weighted average cost of acquisition was different for these investors. The GROW, or the Billion Brains Garage Ventures Limited, their IPO was also 84% was OFS. So we can see that most of these cases, the people, the companies or the investors or the promoters who offered their shares for sale had a very high rate of return because the IPO issue price was much higher than the weighted average cost of acquisition. And the issue price normally presented as multiples of accounting numbers, the profit or revenue, EBITDA or top line or bottom line. But these are adjusted profit. So these are accounting numbers. So invariably, OFS is preceded by certain accounting adjustments. So we will try to understand what are the common popular accounting adjustments you may come across whenever companies go for IPO in general, OFS as a part of IPO in particular. Some of them are as follows. Aggressive revenue recognitions. The companies start loosening the revenue recognition policy. Look for those policies which will increase the recognition of revenue. If the revenue recognition improves, the top line goes up, all other things remaining same, profit will go up. So this leads to a sudden profitability. After years of, we have seen that several IPOs, these companies have been actually incurring loss. But suddenly in the year of IPO with OFS or without OFS, show profit in their prospectus. And these are all adjusted profits. And often you see that these companies may have large other incomes. We'll see some examples. Large other income, showing large other income is another accounting adjustments or accounting game, if you want to call it, and to improve the overall profitability of the company. Extensive use of non-GAAP numbers. GAAP is a generally accepted accounting principle. Two numbers which are GAAP driven and every company has to show in the income statement. There's a PAT, profit after tax or net income, and earning per share. These are all very clearly laid down. But there are many non-GAAP numbers which are used by these IPO companies. They are EBITDA, adjusted profit, adjusted revenue. So these adjusted EBITDAs and all are non-GAAP numbers. And they talk about those adjusted numbers or non-GAAP numbers more before the IPO. Capitalization of expenses is an interesting way the companies use to increase the profit. They try to reduce the expenses and increase profit by capitalizing these expenses. So there's no change in cash, but expense is treated as asset. So expense goes to the balance sheet. So expenses in the income statement reduces. So profit goes up. Capitalization of expense is a very popular approach of reducing expense in the short run and increasing profit in the short run. You may also come across situations where the companies en route to IPO will come across lots of related party transactions. Sales may happen to related party transactions. You may acquire assets and to show that we are doing lots of capex. So these are all related party transactions. So these related party transactions may be with their subsidiaries or some companies, unlisted companies, sometimes even shell companies. And of course, these are all disclosed because GAAP forces you to show the related party transactions. Cash flows not matching the profitability. So on one hand, the companies try to inflate revenue. We know that income statement is accrual in nature. And so the profit can be managed by managing expenses, revenues, as we see in capitalization of expenses. We have also seen aggressive revenue recognition. This may result in increasing profit, but they will not result in outflow of cash or inflow of cash, will not affect the cash flows. So profit has changed, but not the cash flow. Similarly, many IPOs, if you observe, there may be a big chunk of contingent liability sitting in the prospectus. May not be in the balance sheet, and because contingent liabilities are not yet liabilities, but they may become liability in future. So If these adjustments happen, there is every possibility that intention is to increase the profit. Let us take one or two examples just to explain some two recent IPOs. One is a lens card. So in 2023, there's a loss of 64 crore. 24, there's a loss of 10 crore. And in 25, the IPO year, profit is 297 crore. That's all right. A company can make profit. But where is this profit coming from? Is this from the operation? If you see details, they say that the devil is in the detail. If you see the details there, this profit is due to other incomes. The fair value adjustments, which is about 167 crore of some acquisitions of the past, and some mutual fund investments based profit, about 72 crores. So the entire profit is for a one-time adjustment. So it's not from operations. So the loss has become profit and sudden profit not because of operations, but because of certain accounting adjustments, which are mostly non-cash and non-operating in nature. Similarly, Pine Lab, they also created profit. I underline the word created profit through accounting adjustments. And their accounting adjustments was increasing in other incomes, depreciation and impairment changes in that, and a big amount of deferred tax related adjustments. We can see that. So there was a loss of 48 million, 48 million or 4.8 crore. And the loss become 4.7 crore profit. And the significant part of this because of the deferred tax, negative deferred tax. That means it increased the profit. So the deferred tax is an accounting adjustment for the difference between accounting-based tax and income tax-based tax. So tax profit will not be equal to accounting profit, and there is a deferred tax is tax on the timing differences. And that adjustment is responsible for making loss as a profit, converting loss into profit. So we are able to see that the companies going for IPOs are actually making certain accounting adjustments to create profit, to show a better picture. So should we avoid offer for sale? It's a very important question. There's no one answer for that. It depends, I'll say. It may be yes or no. But as an investor, always ask questions. Try to think about what is happening in the prospectus, understand the business, understand the business model, understand the promoters, understand the market. But with respect to accounting, I would like to raise 5 questions. Always ask this question. Is profit driven by other income? Just like Pine Lab, just like Lens Card. The profit, the loss has become profit not because of operations, but because of other incomes. Is the company non-GAAP number like adjusted EBITDA? And these are created as a positive numbers, whereas the corresponding GAAP numbers like PAT, EPS are negative. Did the profitability arrive suddenly? There has been loss for 3-4 years preceding the IPO, but suddenly in the last quarter, there's a profit. Is this profit sudden? Will this continue post-IPO also? Is an important question. Does the cash flow contradict the reported profit? Profit has gone up, but cash from operations still continues to be negative. This happens when aggressive revenue recognition. This happens when you capitalize the expenses. This happens, there are certain fair value adjustments. Okay, these are not cash flows. Is there a large OFS happening? Promoters are downsizing themselves or divesting and want to withdraw. If the answer to these questions is yes, yes to all or majority, then it's better to be careful. Observe, understand a bit more. Don't just get carried away by the issue price, or don't just carried away by the multiples. Don't just be carried away by positive PATs and positive EBITDAs because these are accounting creations. So OFS per se is not definitely a problem. The problem is accounting adjustment made to deceive. The possible intention is to inflate the price and create avenue for the existing promoters and the early investors to make super profit is a matter of concern. So it's always important to examine the numbers. Uh, don't just see the numbers, understand the trend, understand in between line, understand the spirit behind the changes, and then decide whether to go for OFS or not, whether to buy those shares which are offered for sale. Thank you very much.